Hi, I'm Daniel Kertcher, CEO and founder of Trading Pursuits. It's my great pleasure to welcome you to our market review webinar. Now, over the next couple of minutes, I'm going to take you through a recap of what's been going on in the markets over the past week or so. Now, before we get started, there's a couple of points I need to share with you first. Number one, what I'm sharing with you today is what we call general advice. It's not individual specific advice. Furthermore, we haven't taken into consideration your personal financial objectives. Now, trading involves risk. Right? You need to consider those risks and decide whether they're appropriate for you should you choose to trade. And finally, our company, Trading Pursuits, we hold an Australian financial services license. Okay, so let's start talking about the markets. Now, you're probably no doubt aware that this past week we heard some election results for the Greek government. Now, there was a big controversy about whether Greece would elect in a government that was pro the euro or against the euro. In other words, do they want to break away from the Europe Union and break away from the euro and therefore go back to their original drachma currency? Or did they want to vote to stay and fight but at the same time accept the austerity measures? Now, no clear party actually won control, but the parties that were against the euro wanted to break away and go back to the drachma. They were defeated. So overall, the Greek government the Greek people have basically decided to stay with the euro. This has given the market some breathing space overall, because we can now see that, all right, the idea of Greece breaking away from the euro, that's off the table for now. Who knows what could happen in the future? Now, as a consequence, we've seen some results in the performance of the euro. Here we can see the value of the euro against the US dollar. We can see that in the last couple of days, there's been quite a rebound. Now, part of this is due to the fact that the euro was oversold. People were selling the euro in anticipation of what could happen in the Greek elections. Now that we have the results from the Greek election, of course, the value of the euro has bounced back up a little bit. We're certainly not in a bull rally for the euro, but we're no longer falling in value at the moment either. Now, going into Spain for a moment, what has also happened in the last couple of days is the value or the interest rate yields on Spanish 10-year bonds has rallied up. Now, this is not a good sign, because it means that the Spanish government has to pay more in interest if it wants to borrow money in order to help keep running the country. So why would a country have to pay more in interest? Because there's less demand for their bonds. Less people want to invest in Spanish bonds, so therefore the Spanish government has to pay more in interest. Now, this has happened a few times before in the past, and in the last couple of years there's been some intervention by the European central banks. And we can see here back in the past there was a sharp drop in the interest rate yields of the Spanish bonds. This is when the European Central Bank stepped in and they bought a huge volume of Spanish bonds, therefore driving down the interest rate yields. The question now, of course, is with the very, very high interest rate yields for Spanish bonds, will the European Central Bank step back in again and help bring down that interest rate? Because by doing so, that will allay some fears and give some more certainty about Europe. Question is, will they do it? Germany doesn't want to do it. France does, and most of the rest of Europe does. What will happen? Most likely there'll be an intervention, because they'll want to keep the Spanish problem as contained as possible, prevent it from flaring up into a bigger problem like we've had in Greece. So we'll likely see an intervention over the next couple of days or weeks. Now, over in America, U.S. government bonds have exploded. We can see that they were recently, about 2 weeks ago, at the highest price ever for U.S. government bonds. Now, this means that the interest rate yields is extremely low. This means there's been a massive demand for U.S. government bonds. Why? Well, a variety of reasons. One of the big reasons, of course, is that U.S. government bonds are considered to be one of the safest investments in the world. They're also one of the poorest returning investments in the world. Right? The interest rate yields now on 20 to 30-year U.S. government bonds are around about to 2.7%. Inflation's running higher than that in America. So people putting their money into 20, 30-year bonds are literally getting less interest than what inflation is chewing up their money. So they're literally getting a 0 to negative return. But that just demonstrates the level of fear in the market, that investors are prepared to get a negative to 0% return just to protect, just to have somewhere to put their money where they're not going to lose it. People right now are more concerned about getting a return basically return of their capital rather than a return on their capital. And this is a very, very important point, because it demonstrates there's a lot of fear in the market. But we can see in the last couple of days, following the Greek announcements that there's been a drop in the fear, a drop in the price of US government bonds. Now, we're nowhere in a falling, crashing bond market, which would be a good sign because it would show that money's coming out of bonds and likely to go into the other markets, such as stock markets, commodities, and real estate. We're not there yet, but at least the bond prices aren't rising any further at the moment. Now, this has then been seen in the S&P 500 index. The last few days, we've seen the value of the top 500 companies in America shoot back up again. And interestingly, prices now are virtually on par with where they were over a year ago when we had the U.S. credit rating downgrade. So you can see the big drop in the market a year ago after the U.S. credit rating was downgraded. The market then rebounded. It's then fallen and back now to where it was just before the credit rating downgrade. So even though the market has been really volatile, generally speaking, the value of the S&P 500 companies has basically been going sideways for the past couple of years. Now, interestingly, right now, S&P 500 companies are some of the most profitable companies in the world, and in fact are making record profits, higher profits than they've ever made before. At the same time, their debt to equity, that is the amount of debt the company has compared to the assets and the equity of the company, is at the lowest level it's ever been, far, far, far below where it was in 2008 before the last crash. So what this means is S&P 500 companies, despite all this economic turmoil and the chaos coming out of Europe and the rest of the world, S&P 500 companies have actually been ferreting away huge amounts of profit and paying off enormous amounts of debt, putting them in one of the most strongest fundamental positions we've ever seen S&P 500 companies, ever. Now, what have these companies been doing with their profits? They've been paying out dividends, but smart companies have been ferreting it away and actually buying back some of their own company stocks. One of the latest companies to announce this was Oracle. Now, Oracle is a big competitor to Microsoft and other software companies, huge company. And they've just announced this past week that they're going to do a $10 billion US buyback of their own stock. Now, that's about 7% of the company. So they're buying back their own stock, which is an excellent thing to do to help increase the value of the company and the share price in general. So it's almost like getting a dividend to the shareholder. Instead of the shareholder getting a cash dividend, the company's buying back stock, which can help drive the share price up. Now, this is a really, really important thing because while there's all this fear in the market that's driven bond prices to record highs and driven people into bonds, which are really, really poor returning investments, companies have been buying back their own stock. Now, eventually the fear is going to settle down. We will gain certainty out of Europe. We will have, an improved economic situation in America. And when the fear dissipates and money flows back out of the bond market back into other investment classes, such as the stock market and commodities and real estate, there's going to be fewer stocks to buy because companies have been buying back their own stock. This could set it up for quite a strong stock market rally in the future. Now, I'm talking way down the track, at least 6 to 12 months or more from now. But it is a good sign that when all this fear and all this bond prices drop, we see money come back in the stock market, we could be in for quite a strong rally. Switching to commodities for a moment, we can see that oil has now fallen to an 8-month low. Right? This is specifically because the U.S. stockpiles are a bit higher than expected and a perceived slowdown in the Chinese economy. Now, looking at the oil price, we can see that it's trading now down around about the $81 US per barrel. Now, that's around about the same price it's been trading at up to 2-3 years ago, back in 2009. So just like the S&P 500 has been volatile up and down, but generally going sideways for the past couple of years, so has the oil price. And you can see now how the oil price has come down to that strong support line around the $75, $80 mark. So in my opinion, we'll likely see oil settle down around this level now, unless there's any further news of chaos or uncertainty coming out of Europe. Short of any bad news coming out of other parts of the world, we'll likely see the oil price settle down around that $75, $80 mark. Now, commodities in general, what you're looking at here, this is the broad-based commodity index. This is a index made up of not just crude oil, but also gold, aluminium, soybeans, a variety of agricultural wheat, variety of agricultural base metals, copper, etc. So we can see commodities in general, right, have fallen back in value. Now this has been a whole bunch of different reasons, namely the fear in Europe, the slowdown of the Chinese economy, right, the rally in the value of the US dollar. All this has worked together to bring down commodity prices. But once again, commodities are down near a pretty strong support line. So if oil can hold at these levels, we'll probably see the overall commodity market also hold at about these levels. Now, the commodity market falling has driven down the value of the Australian dollar against the US. And we can see that the Aussie has come off its high from a year ago of about $1.10 against the US, down to recently about 96 cents against the US. Now, in the last couple of days, it's rallied back up again to just over parity, about 101 against the US dollar. Now, part of that has, of course, been, again, this election result in Greece. A lot of people were overselling the Australian dollar with an anticipation that the Greek results could go differently. Now that we know what happened in Greece, money's poured back into the Aussie dollar and helped drive it back up again. So long as commodities can stay where they are right now, right, we'll likely see the Aussie dollar continue to hover around this level. The Aussie dollar also fell because of the interest rate drops in Australia by the Reserve Bank of Australia, but we're not likely to see any more interest rate drops so long as inflation in the economy in Australia remains steady where it is, which is a likely result for at least the next couple of weeks and months. Now, the Australian ASX 200 index, right, the top 200 companies in Australia, right, they fell in value again with this fear coming out of Europe in the lead up to the Greek elections. But following the elections, we've seen a bit of a rally in the value of the ASX 200. Now again, the ASX 200 is down around that strong support line. So once again, if commodities can hold and we don't get any more further fearful things coming out of Europe, we'll likely find, in my opinion anyway, that this will be around the bottom for the ASX 200. Now, I certainly hope you've enjoyed this weekly update. May I wish you all profitable trading.